When many traders look at a chart like this, they simply see price moving up and down. Based on the strategies they were taught, when price moves up to the top, they sell, and when price moves down to the bottom, they buy. But many times, something frustrating happens. Price suddenly breaks out instead of reversing. Their stop loss is hit, and they are left disappointed, wondering what went wrong. Why does this happen? It happens because many traders fail to understand the real principles behind why price moves and why it reverses. In this lesson, you are going to learn something important. You will see how support and resistance are formed, why price reverses in those areas, and how to trade support and resistance zones more effectively. Let's start with market movement. When price is in a bearish move, it normally forms a lower low and a lower high. This shows that sellers are in control of the market. But within that bearish move, price often slows down and begins to move sideways. This is where we start seeing consolidation and the formation of support and resistance zones. Inside this zone, price often forms equal highs and equal lows. This means price is bouncing between two levels while the market prepares for the next move. Now, an important question arises. How can you tell the difference between a normal consolidation and a true support and resistance zone? The answer is simple. Look at the momentum of the candles. Small candles with weak momentum usually show retail traders pushing price up and down inside a consolidation area. The market lacks strong conviction there. But when you see large momentum candles, that tells a different story. It shows the involvement of institutions and smart money entering the market. These strong moves often form real support in resistance zones where the market reacts strongly. Now, when price reaches the resistance zone, which we can think of as the ceiling, price often struggles to move higher and begins to reverse. On the other hand, when price reaches the support zone, which we can think of as the floor, price often finds buyers and begins to move upward again. These areas become key zones on the chart where important decisions are made. But the next question is even more important. Why does price actually reverse in these zones? Let's look at the principles behind price reversal. The first principle is manipulation and liquidity sweep. When you look at a resistance zone or supply area, you may notice that price was previously moving downward toward a support zone. This downward movement often happens because there are many sellers in the market and fewer buyers, creating selling pressure. However, institutions see something different. They see liquidity and opportunity. When price reaches a demand zone at lower levels, institutions begin buying at those cheaper prices. At the same time, they may push price slightly lower to sweep liquidity, triggering stop losses and capturing orders in the market. Once they have accumulated enough positions, they push the price upward. This sudden move often creates a strong reversal, forming a new resistance zone. If you want to understand this manipulation principle deeper, you can watch my previous video on Manipulation Principle Part 5. Another reason price reverses is to fill imbalance in the market. When institutions enter the market with large orders, they often create strong displacement candles. These candles move so fast that they leave behind areas where price did not trade efficiently. In ICT trading concepts, this is called a fair value gap. Price often returns to these gaps to rebalance the market before continuing in its original direction. Another reason price reverses is human psychology. Traders remember levels where they previously made profits. For example, traders who bought at support and made profit will want to buy again when price returns to that same level. The same happens with sellers who previously sold at resistance and made profit. They will often sell again when price returns to that resistance level. This repeated behavior creates strong reactions in those areas. Another powerful reason for price reversal is market manipulation designed to stop out retail traders. Sometimes you will see a candle with a long wick suddenly spike above resistance or below support, only for price to quickly reverse. This is often called a rug pull type of manipulation, where the market temporarily moves against retail traders to trigger their stop losses before moving in the true direction. You will understand this concept in greater detail when you join my personal mentorship program. Once you begin to understand these reasons behind price reversal, you will start positioning yourself before the reversal happens, giving you a much higher probability of profitable trades. So when trading support and resistance, Always pay close attention to the candles when price reaches those key zones. If you see a strong displacement or momentum candle, it may mean the zone is about to be broken. But if you see a rejection candle with a long wick, it often signals a potential reversal. These are important clues the market gives you. What you have just learned is one important part of support and resistance called pivotal support and resistance. But that is not the only type that exists in the market. There is another more complex form known as range support and resistance, which in the ICT concept is called inducement. This is where the market creates a range to attract traders, build liquidity, and then move in its real direction. As you continue to follow my videos, you will learn how to identify these areas and understand how to trade them with confidence. So make sure you subscribe to the YouTube channel using the link in the comments section so you don't miss any of the upcoming lessons that will deepen your understanding of how the market truly moves. Finally, remember this important principle. Price always moves toward where liquidity is located. Many traders believe liquidity only exists at equal highs and equal lows. But smart money knows that liquidity is located in many other important areas of the chart. In my next video, I will reveal other powerful areas where liquidity hides and how understanding them can help you determine where price is most likely to move next. So make sure you follow and stay connected, because the more you understand the logic behind the chart, the more confident and profitable your trading decisions can become.